When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about today's economic, market, and geopolitical news that retirees and near retirees should be considering. We'll also answer listener questions and finally, declaring your financial independence. My name's Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, happy 4th of July weekend. How you doing today?
I am doing great. How are you doing?
I'm doing fantastic. Thank you that we're together on the radio again. It is the 4th of July weekend. We're celebrating 250 years of freedom here in America, and we really are grateful to live in this great country, and we're grateful for all of the fine people that join us every week here on Premier Retirement. Jeff, there certainly was no shortage of economic news this past week, so let's help our listeners understand what really matters to them. The Dow closed above 52,000 for the first time ever, Jeff, and stocks rebounded after last week's pullback. Does that mean that retirees can necessarily sit back and breathe a sigh of relief?
Well, I don't know. The Dow is only 30 stocks, and they're kind of hand-picked. Sometimes they can be manipulated, and one or two stocks can have a good day and make that whole index look better than the broader market is. And that's what I've seen lately. This market's difficult to trade in because there's not that many stocks that are performing on a day-to-day basis. It's like one day it's biotech sector, next day it's pharmaceuticals, next day it's tech, next day it's AI, next day it's the industrials. Mostly the AI keeps coming and going. We've got a lot of the semiconductors that are way overrun, overbought. I mean, shoot, they've been pushed up some 100% in just the last few months. I think you're getting overvalued and people are looking to take a little bit more of a conservative approach, which is why the NASDAQ's been suffering a little bit more, which is more the high-tech stocks, and the Dow is typically more of the blue chip, the 30 biggest stocks that I think people go to for, if you want to call it safe haven stocks, even though stocks are not safe havens. The market does what the market's going to do eventually. It's got to correct. I mean, it always has. Every time it gets like this, and there's this euphoria that we're seeing right now with the dumb money, because we're not seeing smart money going into the market. We're seeing pension funds liquidate and go to cash. We're seeing Warren Buffett go to cash. We're seeing big hedge fund managers that have been all in the stock market for quite a long time and done very well at it, going to cash. And they see the AI boom fizzling out because of the fact that it's priced in as if it's a perfect market, that every company is going to exceed expectations, that every company is going to get 100% of the sales in their category, yet there's competition in each category. So when it shakes out, there's not going to be as many earnings as are projected. That's just a way to get the stock pumped. And it's a way to get pension funds, institutions, the big banks out of their stocks while they pump and cheerlead the public into buying these stocks, pretending that there's going to be these never-ending growth rates and income rates. I just don't see it happening forever unless they just continue to manipulate it. But then again, we've kicked the can down the road quite a long time. How much longer can we kick the can down the road? I don't know. The market always does what it's supposed to do, and it will correct. It does it at its own timing. And that sometimes is because of manipulation. Sometimes it's just because of fake belief and hype and hope. And I think that's really more where we're at right now. I just looking at the market, it's probably the hardest period of the last few months, hardest period of time to actually trade and look at investments that have any type of fundamental backing to them, because the ones with fundamentals don't go up and the ones without fundamentals somehow get this surge of price increases. And it's baffling as to why. I think there's a lot of AI algorithms playing with the market, and there's a bunch of people on Robinhood on their phones that are still, I typically call the Robinhood investor the young investor that's just starting out, because they do fractional shares. You can open an account for $5 and things like that, meaning the dumb or the non-sophisticated money investor. I don't mean that they're dumb people. They're just not in, they don't have all the information. All they have is whatever the hype is or whatever the note is on the stock market. So sometimes the stock will go up and they'll give it some reason that sounds logical. Everybody like, oh, that sounds logical. Let's buy some more. And it may or may not have any reason to do that. So The market's a little bit skittish. I'm really amazed that it's performing as well as it is. I'm happy that the Dow's making a new high. That's great. It keeps the people who do have money making money and keeps the people that do have money able to buy things so that the people who work at the stores, the people that don't have money that work at those stores can at least get paid and have salaries and pay their bills. So there is a benefit to having a good market is the people that have money will spend it. People that don't have money still don't have money, but at least they can pay their basic bills. If there is a market crash, I think a lot of that will filter back not only those people who have money or think they have money, will find out that they really are living on the edge and don't have as much money as they thought, or it doesn't go as far as they thought because they're not making 20 and 30 and 40% a month on a stock trade, and they have to kind of regroup. But at that point, we typically will get some sort of a recessionary reset period where sometimes we don't necessarily get deflation, but we get prices and even consumer goods come down to more normal levels. Producer prices go down a little bit. And we might be able to get this inflation a little bit more under control if there is a correction in the market. So it's kind of a catch-22. As the market keeps continuing forward and interest rates have to keep going up because of inflation, a lot of that's oil-driven from the war in Iran that is probably going to be a never-ending war, just like everybody who has seen these in the past know it will be. Yet Trump, the eternal optimist, thinks it won't be. Maybe he's right. I hope he's right, but I'm lacking confidence like most people are in when this thing can get over and if it will get over and if it will ever realistically drive prices down to a level where it will filter back into less inflation. And I hope it does. So again, the market going up is good in some ways, but it's kind of an indication that maybe it's a little bit overbought. It's a little bit deceiving in the fact that it makes it look like even though the economy's good, it just means the separation of classes is getting stronger and stronger. But I don't think the middle class has a lot of Dow investments. In fact, more than 50% of people who are working don't have 401ks, don't have savings, don't have anything. So for half of the people, it might be a good thing. For the other half, it makes their life probably even more difficult. It's unfortunate, but that's the way it is. I think that's why we're seeing, I don't want to get too political here, but I think that's why we're seeing this huge increase of socialism, communism, or whatever this Democrat Party is trying to do, is just give everything away. It's basically, oh, well, the half that's making money, we'll just take it from them and spread it around. We'll be Robin Hoods and make everybody happy. And the fact is there's so many people that aren't making it, they can actually get those votes because they're going to say, hey, don't worry, we'll just take it from your neighbor and give it to you. And most people now, unfortunately, are saying like, okay, that's all right. That's great because I need stuff. It used to be that, no, don't give me anything. I want to earn it myself. I want to live the American dream. I want to have the pride of ownership. I want to have the happy ending from all my work. I want to do the grind just like my parents, my grandparents, and my immigrant great-grandparents did, and make it on my own. That's what character used to be in America, but now it's like, oh, America, the land of the free and the land of the free stuff. Not freedom, it's land of the free stuff. And unfortunately, somebody has to pay for that, and eventually, I think it's going to blow up. It is what it is. The market hit a new high, the Dow hit a new high, but we haven't seen the S&P and the NASDAQ get back. In fact, most of the indexes, in fact, the Dow is barely above break even from 4 to 6 weeks ago, but it just barely got above its high a while back. The other indexes, I think, are still trailing their highs, just getting close to it over the last month or so, just kind of bouncing around, holding their own. So I think this is either a pause before a new breakout session there has to be some sort of a catalyst to make the market go up higher than that. But there are a few stocks that are seeming to get attention and going up. And if you can get on those rides, great. We're trying to get on those rides as we manage portfolios, but we're right a lot of the time, and it's difficult a lot of the time, to be frank. So, if you're trying to manage your own portfolio, don't be surprised if you're not beating Warren Buffett, who, by the way, is down for the year. What I mean is beating him by even a little bit or even losing a little bit. Don't worry, there's other big managers that are hoarding cash that are down when they're managing huge portfolios of really impressively run companies and stocks that shouldn't be going down, that should be the ones getting all the attention. But instead, we're getting all the speculation, and the greed factor is definitely driving the market right now. It's not really fundamentals.
We're talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about current events. Our phone number, 520-780-9059. Listening this weekend, you would like to declare your financial independence? Maybe it's a good time to call that number and sit down with Jeff and talk about what's on your mind as far as your investing for retirement or your retirement goes. It's not going to cost you anything to have the conversation. 520-780-9059. You can make that call right now. Leave your name and number, and Shelley will call you back on Monday and set up that appointment for you. Once again, it's 520-780-9059. Jeff, you mentioned interest rates. They continue to dominate the financial conversation. Treasury yields moved a little higher this week, and investors are still trying to figure out what the Fed is going to do next. What do you think Kevin Warsh is up to? What's the takeaway here? Why should we be looking at this?
Well, I think we need to get to know a little bit more about Kevin Warsh. I think we assume that because Trump appointed him, he's going to be, in favor of lowering interest rates and so forth. But in fact, interest rates have gone up. Just in the last week, the bonds, the 20-year Treasury, I'll just look at that. We could also look at the aggregate bond, but the 20-year Treasury, it's more the long-term bond, was down a couple tenths of a point just for the week. Now, for the month, however, interestingly enough, even though interest rates are going up, typically that means the bond prices go down a little bit. In other words, bond prices go down, interest rates go up, the interest rates on the bond. So it usually reflects evenly, but the coupon rate on those bonds are going up a little bit and people are buying them. So they're actually bidding up the price, which means that if interest rates go up, but they bought this bond 3 weeks ago, they're actually break even on the interest rate because they just basically, their interest rate is changed opposite to it. However, if they sell the bond, they're already up a couple of points in less than a month. So bond traders are getting kind of happy with the bond market the way it is, because not only can you buy a bond with higher interest, you can actually sell the bond you bought a few weeks ago for enough more that it pays off. So, if you have old bonds, typically with the new bonds costing more, you typically can't sell a bond you bought a week ago for more, but lately you can. And what that shows me is even though people can lose money or basically buy bonds at an overpriced value, comparatively speaking to the interest rates, they're willing to do that and they're willing to buy bonds knowing that interest rates will probably go up and the price of their bonds will probably go down. So kind of an interesting thing there, because most bond traders know that, or people that are hedging use bonds as kind of a safe haven. And it's interesting because usually when interest rates go up, their bond portfolios go down. But because so many people are buying bonds, they're actually going up with interest rates, which is kind of an anomaly and kind of backwards the way it should work. So that, in my mind, is just telling us that the market's kind of broken and that we need to take a little bit extra caution, especially when we see how much interest there is in bonds and they're still having to raise interest rates, which typically puts brakes on the economy, typically makes stocks go down. It doesn't seem into effect. People are just blindly buying stocks. They don't care. It's just they're going up. It's a feeding frenzy. I don't know how long it can last. It's kind of bizarre. It lasted a few years in the dot-com bubble. It lasted a few years in the bank crisis bubble, pre-08, probably 04 to 08 timeframe or 07 timeframe. We've had the AI bubble kind of brewing for a couple years now, and semiconductors to support that, energy to support that. There's a few different sectors that are really pumping along, and they're kind of helping each other out. And if it plays out, those are all going to end up being good investments. But I think that people are going to have to see them come back to reality and come back to a value that people are willing to pay for based on looking at those investments as a real investment in a real business, rather than just, hey, there's this thing with a ticker symbol that we can buy and sell for more tomorrow. And that's kind of how the market's working right now. It almost doesn't matter what the business does. You're not buying a business. You're buying 3 letters in those New York Stock Exchange that we hope goes up and we can sell either tomorrow or in a couple of years. People don't seem to be buying and holding that much. I think if you buy and hold anything, it ought to be just the index, because over time that always plays out and it's diversified. But if you're trying to pick the next big stock, it's a crapshoot.
Jeff, you and I live relatively close to each other, and in my particular neighborhood, there are 5 homes for sale. They've been for sale for quite some time. Mortgage rates have eased just a little bit, but they remain around 6.5%. And I think it's sort of a standoff here between buyers and sellers. Buyers are not willing to lower the prices, and sellers are not willing to pay 6.5%. Or even more than that. What advice would you give to retirees considering moving or downsizing at this time?
Well, I mean, if you're a retiree, most retirees I meet have their house pretty close to paid off. Some people are using arbitrage with a low interest loan, meaning that they probably got a loan under 3%. They don't want to sell their house because if they did bring that mortgage with them, because they appreciate the fact that their money's invested making more, even on safe money, it's making more than the 3% they're paying on their mortgage. So I think interest rate arbitrage is smart. But if you're going to refinance a house and roll that mortgage into something at 7%, I hope it's because you're downsizing in a big enough way and because you've got enough cash flow that you can pay down that mortgage quicker, especially if you're borrowing around 7%, which we're starting to inch up to that level again. Anything over 6, I mean, twice the interest that you're paying on a 3% loan, I mean, that's a huge cash flow problem if you're buying a like house to a like house. Some people who are retired just have a big house and they just don't like managing the yard and paying the landscaping bill and the water bill and all the other things that go with big houses that they had maybe when they were growing up a family and needed the room, but maybe now it's time to downsize and maybe you can take the equity out and just pay cash for something a little bit smaller that you don't have to spend so much time maintaining. Still leave your money working for you, not have to pay the landscaper and the big water bill and the taxes that go along with a bigger house. So I think downsizing is always an option to enhance retirement, increase cash flow, maybe decrease your stress a little bit, especially about the maintenance issues and just taking care of a bigger place. And also maybe you want to move someplace where it's closer to the grandkids or closer to your kids or closer to maybe where the weather's a little bit better. You have 4 seasons, you're tired of the heat because you don't want to have 2 houses, have to have one to go in the mountains. You get one that's somewhere in between. Everybody's got a reason to move or think about changing their real estate. But as far as retirees or pre-retirees go, you've got to be wise about how you balance that. If you have a mortgage or you have a significant portion of your home finance, because if you go into something else, it's going to be higher. Now, I understand that if you've got a house and it's financed at 3%, you can't really lower the value of your house. It's better to get top dollar because you're going to have to get a smaller house and get a bigger mortgage if you are using leverage to buy that house. Or maybe you have to take a penalty to get out early because you're pre-retiring, you're in your 50s, not in your 60s or 70s yet. So yeah, everybody's situation is going to be a little different. Some people it makes sense to finance. Some people have great cash flow and it's better to leave your money invested for the future in order to take advantage of stretching out the payments on purchase of that home, when down the road, maybe you'll have something you can cash in or a big retirement bonus check that you can cash in some company stock, pay that loan off, and then have a smaller nut to crack every month when you retire without having a mortgage. So everybody's plan is going to be different. There's no right or wrong whether you have a mortgage, whether you want a 7% mortgage. I've got clients that are happy to refinance their house at 7% because they've got a ton of debt and things like that. Maybe they did some air conditioners or have some credit cards or help the kid out and find themselves buried under $50,000 to $100,000 of extra debt they keep raising rates 20 or 30%. Well, maybe if you got a $100,000 mortgage and you push it to 200, but you pay off all those loans, maybe your cash flow improves by $1,300 a month. I mean, if that's the case, then cash flow is king. It's not necessarily about how much debt you have. It's how much you pay on that debt, and higher interest debt is still worth rolling into possibly a 6 or 7% mortgage on occasion. Now, I hope you're not in a position where you have that much debt that mortgaging your house in order to pay it off is the only option, but for some people it makes sense. And it may not be the only option, but it actually makes mathematical sense, especially if you've got good cash flow, guaranteed pension, Social Security, and other things that are going to guarantee that you'll never miss that mortgage payment. What I am worried about is somebody takes on too much mortgage to pay off a bunch of debt, but doesn't have the cash flow to pay the mortgage. Now you not only had a bunch of debt, that you paid off all the unsecured debt, now you've got debt on your house and you could lose your house. So you have to see the big picture. You have to see into the future. That's why we do 30 and 40 year plans. Not, let's see if the next 5 years does okay in the market. We'll put this money away long term and let's have 3 buckets. Let's plan for the next 5 or 10 years. No, let's plan for the next 30 or 40, because there are things like mortgages that do impact you for decades, not just a few years.
Talking with Jeff Hogan on Premier Retirement. Once again, our phone number, 520-780-9059. If you'd like to get in and sit down and talk with Jeff, no cost, no obligation, and no judgment. We'll meet you where you are, 520-780-9059. Jeff, I filled up with gas just the other day at the Fry's here, and it was under $4 a gallon for 87 octane. Oil prices seem to have dropped a little bit. What has happened there? Something adjusted in the Middle East? Why are we seeing better prices at the pump?
A couple of reasons. One is that they made it more efficient to pump locally. And so a lot of those wells have been uncapped, and there's a lot of local production that has increased in the U.S. And other markets are now adding to the imports. However, oil prices in general haven't come down enough, I don't think, to justify long-term price decreases. I mean, we had the idea that there was some sort of a settlement in the Middle East and, oil went way up and then now it's coming down. And I think when it went way up, the gas shot even more way up. It kind of overshot the numbers because I think they anticipated the tightening of supply and this protracted war type thing that would never end. And now there's some glimmers of hope. They're negotiating. Price of oil have come down and it's being reflected in the current gas price. I think where we're at right now, which is still about $1 higher than I remember less than a year ago or just 6 or 8 months ago, it still seems high, but I think it's at a level that could be sustainable if oil kind of maintains its present cost, which is, again, higher than it used to be. But I think we could get $60 a barrel oil again. The economy plugs along really good because the cost of everything goes down. It's amazing how dependent we are on oil worldwide because of transportation. You can't make everything electric. I mean, if we did, talk about power centers that we would have to have, not just for electricity to run GPUs and stuff for AI and data centers and things like that. Well, we'd have to, I don't know how we could charge enough cars and vehicles to make all the transportation happen. I mean, when are we going to get an electric 747. I mean, I don't think that's going to happen anytime soon. That's going to be an oil-based product, I think, for a while.
Yeah.
I don't know. Maybe we can get some of that UFO technology, that anti-gravity stuff, to where we don't even have to worry about it. Maybe it's just all magnetic. And if we can use that technology and everything, then we don't need oil or anything.
How about solar plate collectors on the roofs of cars or on the tops of airplanes? We got a lot of sun here.
I have no idea why they're not already doing that. I think they need to probably because it takes a lot more power than one little panel on a car could generate. It'd be kind of an eyesore. And a rock hits it and it breaks. It's probably it's a little more expensive to replace a car roof that's a solar panel than it is to fix a rock chip with a little paint dab. So I think that's probably the main thing. But I think oil, it seems like we found kind of an equilibrium where it's not jumping around quite so much. It has come down. It's coming down now based on decreases in oil a couple of months ago when they first decided there was going to be a negotiation and they were going to quit bombing each other. So if we resume that, we'll probably see some more upward pressure in the cost of oil and gas prices. But I'm just happy to see a 4 on the number when I pump my premium and see a 3 on the number when I pump my regular. Now, I would love to see something under a 6 on diesel. I haven't seen that in a while. I don't know if it's down in the 5s yet, but I haven't filled up yet this weekend, but we'll find out soon. I didn't notice the prices. Anyway, bottom line is everything's still costs more than it did. It stinks. Food, everything that you buy is going to be more expensive as long as this deal with oil is a problem, until we can get more manufacturing at home or from other countries. Oh, by the way, speaking of other countries, Venezuela just got rocked by a couple of earthquakes. That's certainly not going to help the oil situation. I'm really surprised it hasn't filtered already into the oil prices in the market. They went up a little bit, but not as much as I would have anticipated, and we haven't seen it reflect in the gas pumps yet. But I don't think we've been pulling, that heavy crude stuff, and I don't think they're doing a ton of oil and gas production from Venezuelan oil. I think it's helping, but I don't know that it's as critical as the Middle Eastern oil.
Jeff, we have talked about a lot in this segment today. When you step back and look at everything happening, what's the biggest lesson that retirees should take away from our conversation?
The name of our company is kind of long: Premier Retirement Planning and Wealth Management. So you got to manage wealth through all these obstacles. You got to plan for it. You need a plan. It's pretty self-explanatory in how we name what we do in our business is create a plan that takes into consideration unknowns. You can't base everything on a historical average, like, oh, the market average is 10%, so let's just take 10% every year out and we'll be fine. That's not true. Wall Street even says less than 4% is the rate you can comfortably take out without running out of money because of volatility. You have to build volatility control into your plan by creating income streams that are guaranteed, secured, insured. You have to build a tax plan so you're not overpaying the government for all the work they do and all the shenanigans they pull and pay for. Yeah, I did say they do some work, but unfortunately we overpay for what we get, I think, in taxes. So you should keep more in your pocket as much as possible. So just having a plan that makes efficient cash flows happen, guarantees that your bills are paid every month, regardless of gas prices. Have a little bit of fluff or a buffer in there that if you did want to take a trip, even while gas prices are high, it's not going to devastate your plan. That's always a little bit of extra cash flow for those what ifs. Gas prices and inflation aren't going to be a thing that's going to be way overblown forever. They're going to come back. Bottom line is have a plan, build in some flexibility, learn how to sleep at night, knowing that your bills are going to be paid from the time you retire till the time you pass away and leave whatever's left to your heirs.
Good conversation, Jeff, as we celebrate America's 250th birthday this weekend. It's the perfect time to think about declaring your own financial independence. True retirement freedom isn't measured by where the Dow closes today or what the latest headlines say. It's measured by knowing that you have a plan, as Jeff said, one designed to provide reliable income, reduce unnecessary taxes, manage market risk, and prepare for rising healthcare costs, among other things. If you'd like to talk about declaring your financial freedom, call us here at Premier Retirement at 520-780-9059. That's 520-780-9059. Request your Premier Retirement Roadmap. Absolutely no cost and no obligation. All right, Jeff, time for a break here. When we come back, we've got listener questions. Then later, we'll explore what it means to declare your financial independence when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk. If you're driving right now, you know how important it is to stay focused and alert. But when it comes to your finances, does it sometimes feel like your financial advisor is asleep at the wheel? At Premier Retirement Planning and Wealth Management, we have our hands firmly on the wheel when it comes to your 401k, IRA, taxes, Social Security, healthcare, and legacy planning. We proactively scan the horizon for hidden hazards and seek out potential opportunities to help ensure you can enjoy your retirement journey. It's time to experience what it's like to be more than just a name and an account number. Premier Retirement Planning and Wealth Management was created to serve you, not a bunch of shareholders. To learn more and to get your complimentary financial review, visit us at premret.com. That's PREMRET.com. Or call us at 520-780-9059. That's 520-780-9059. Premier Retirement. It's your money. Keep it that way. Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for joining us for Premier Retirement this weekend. From all of us here, including Jeff Fogan and Shelley and Monica, everybody in the office today, we want you to have a safe, happy, and blessed 4th of July. Here's to celebrating both America's independence and your own financial independence. By the way, we're on the air for you 4 times this holiday weekend. Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sunday at 11 a.m. If you've missed any part of the program, of course, we're always a podcast. Go to wherever you get your podcast and search for Premier Retirement. You'll find this show and many of our past shows so you can stay on top of your journey towards a financially confident retirement. Okay, Jeff, time for listener questions here. We'll dive right in. We've got 3 this holiday weekend. Max is in Dove Mountain, and Max says, my wife and I have enough saved in our 401k, Social Security, and other investments to comfortably fund our retirement without ever needing to touch our $125,000 Roth IRA. Our plan is to leave the Roth invested in an S&P 500 fund, let it continue growing tax-free, and use it only if we ever need long-term care or in-home care. If we ever need it, we'd like to pass it on to our family tax-free. Jeff, do you think using a Roth IRA as a self-funded long-term care plan is a smart strategy, or are there potential drawbacks that we should be considering?
I don't know. I like LIRPs for that, life insurance retirement plans, because the life insurance not only gives you a death benefit that's far bigger immediately than your Roth would be, you can still borrow money out of it. It never sends a 1099 to the IRS like the Roth would. They may start considering it provisional income, whereas a loan against life insurance doesn't. And I've talked about LIRPs on this program. If you've been listening a long time, you understand kind of the concept. But very briefly, it's kind of a version of a Roth. However, there's access to the death benefit, which is actually more than the balance of the account for long-term care purposes or for terminal illness and other things. So that might be another alternative. And you may want to just split the money between the Roth and a LIRP for each of you in order to accommodate kind of a diversification plan. Now, the S&P 500 is also the index that we used in the LIRP. So you get some upside. The difference between that is that if the S&P crashes 50%, your Roth crashes 50%, and you already pay taxes on the whole amount. With the LIRP, it's principal protected in the fact that it may go up only 10% or so on a good year, but it doesn't go down when the market crashes. And over time, it doesn't average quite the same as a S&P fund does. But remember, when you take money out of a Roth, it's gone. When you borrow money from a LIRP, it's still in there growing. So you might find out that the overall benefit and the overall cash flow could be higher in a LIRP. You would also have more accessible cash for long-term care purposes if that's really what you're using the Roth for. If you're just using it for a long-term bucket to pass on to your heirs that you don't want to touch, sure, an S&P fund might be great. I would probably go with the Qs or the NASDAQ better. Over time, it's actually outperformed S&P, especially with all the tech and the innovation that's happening and how quickly it's happening right now. I'd probably skew it towards that index more than the S&P if you're going to just use a passive index. Or you can have it managed and do even better with it that way if you have a good manager. We feel like we're good managers. We could possibly mitigate risk when the markets get ugly. We go to more safe accounts and don't ride the market down 50% if we have another crash like 2008 or 2000. And I think we're definitely due for one if you look at where the market is valued and look at history and the fact that it's always corrected when it's at values as high as it is right now. So I think you eliminate some of the volatility by maybe diversifying or considering adding a LIRP to your plan and maybe looking at your overall picture for income and other sources. The other thing I would consider is long-term care and healthcare is typically a tax write-off. So I'm not sure you want to use Roth money for that because you're giving up all those tax savings and paying bills with something that you could otherwise maybe write off. It might be an opportunity to dip more into your IRA money and take more of it out than your required minimum distributions in those later years in order to deplete the IRA and get an offsetting tax deduction that would cover most or all of it, depending on what your other deductions are and if you can get past the standard deduction. But from a tax standpoint, I'd rather use my IRA and the residual there for long-term care because of the offsetting tax deductions, and leave the Roth intact for the heirs if that's what you want to do, is leave a legacy.
Max, great question. Thanks for listening to us. And Dove Mountain, once again, if you want to further the conversation with Jeff, 520-780-9059 is the number, and we would love to help you out. Next question, Jeff, is Suzanne, who's in Sahuarita. And Suzanne writes, "Hey, Jeff, I really enjoy your show, and I have a question for you. My boyfriend is a retired widower, and I'm a retired widow. We both have grown children and our own homes. We're discussing marriage and want to know how to keep our assets going to our respective kids. By the way, he's going to sell his home and move into mine if and when we get married. I'd appreciate any advice or resources on how to handle this less romantic side of the relationship."
Well, you can always keep property and assets in called sole and separate property if you never commingle them. Now, obviously, if you're moving to the same house, you're kind of commingling that house. I don't know what you're going to do with the assets there. My mom did something like that too. She kind of left her house to a couple of the boys that trashed it, but she moved in with her husband after my father passed away. After several years, she found another guy and moved in with him. And that house always remained intact for his heirs. She was just a roommate at that point from the standpoint of title and deed. And then when she passed away, even though she could probably have had some sort of a claim if she wanted to go and try to probate it and take it and say, I was a spouse and I deserve it and blah, blah, blah. But she didn't. She just said, here, the house is yours, kids. And they took the proceeds. There was a reverse mortgage on it from this guy's prior wife, and that was paid off and the equity was distributed to the children. Meanwhile, mom could have stayed there had she tried to force the issue, but she had a house. She still had her own home, and she moved back. Now, had she sold it, that might bring up a different problem. So maybe the person moving is going to sell his house. He's going to pay you for half of it. Then you jointly own it, and that house gets split evenly towards all the beneficiaries. Now, you can put a whole bunch of names on a beneficiary deed to a house, I assume it's in Arizona, and pass it on a percentage basis to a whole bunch of kids. And so you could have that house still be divided up amongst all the children. The other thing you should do from a standpoint of my estate planning background, and do a lot of it, you could do separate trusts and just keep all your assets in trust. And however you pay your bills is kind of your thing. Maybe one of you takes care of the utilities and one of you takes care of the food, whatever works out. Or you end up having to keep all your main assets separate and you have a joint account where you each just pay in a couple $1,000 a month and you use that for cash flow. And then you want to treat the other one to a trip or to a nice gift, you pull it out of your own cash and you give it to them. I mean, it's not bad. I mean, it's not like, oh my gosh, we've got this huge problem to work with. You don't need to commingle assets. You can keep them separate if that's your desire, if you're both on the same page. If you do commingle the assets, then the last one who dies is going to win, just period. That's kind of a scary situation. What I mean by that is the last one who dies isn't necessarily going to say, okay, everything's mine, I'm going to give it to my heirs. But they can, and some do. And even if you trust the person with a joint trust, sometimes they don't act. And I've had people come back to me that were clients and say, well, I want to change the trust now. I'm like, wait a minute. Your deceased husband was my client too. I'm not going to change the trust because he wanted that half of the trust to go to his kids. You want to do that trust, find a sleazy attorney that's willing to write that trust for you. Bottom line is, I would call them sleazy attorney because they're not honoring the wishes of a trust. We're supposed to trust each other. Yet, nevertheless, you don't have to. You could just tear up the trust and let everything go to probate, and basically just the heirs of the last decedent is the only ones that are going to really matter in court in a probate process. So, you need to think that through. Make sure you have the documents that provide protection for each of your assets. Never commingle the ones you want to stay in your family, and you can be safe and still get married and still have those assets, live your life together, enjoy each other for all the right reasons, and deal with the non-romantic part of that with trust and with some barriers and some disciplined language that explains what the purposes of each of those accounts are. And if you keep them in trust in a separate name and never commingle them, you're better off.
Suzanne, thanks for listening to us in Sahuarita. If you'd like to further that conversation with Jeff, once again, the number 520-780-9059. You can make that call right now if you want. Leave your name and number for Shelley, and she will get back to you. Okay, Jeff, next question is John in Catalina Foothills. John says, Jeff, I hope you can help with a delicate question. I have 3 children. The older 2 have families and are doing well on their own, but the youngest, who is 29, has failed to launch. He did not go to college or learn a trade and works low-level hourly jobs. He lives on his own, but we pay his rent and give him an extra cash stipend every month. My wife and I are 70 and are beginning to draw down our retirement savings funding him. Do you have any advice on how to push him out of the nest and learn to fly on his own, so to speak?
Well, he's been flying on your dime for such a long time. I don't know how that's going to be possible. And if I were him, I would definitely not move out until, as long as you're paying my bills, no reason to launch. So I think, pardon the frankness, but you're enabling him to be a sloth, to not launch, to not do anything. He's 29, you're 70. I mean, you shouldn't be jeopardizing your retirement for that. I mean, if you don't want to just cut him off completely, just say, hey, by the way, this is coming out of your inheritance. And when your third is used up, you have to move out because you're going to be prepaid. We're saving the rest of it for our other children or whoever else is, if that's the case. But I think the only way, if I were in that position, the only way I would ever move out and launch on my own is if everything was cut off. And then I was backed in the corner. I would pretend to hate you and think you're awful and tell you how awful parents you are. But you know what? I'd probably someday be very, very respectful of that decision, because if you're in your 70s, I mean, you're not going to be there forever. And he's only going to inherit enough to try to get him by for a few months. So by the time he's 40 or 50 or 60, someday he's going to have to launch. And what are you going to do with low-level jobs and no experience? So maybe you give him a few years, say, hey, look, we'll pay for a little college education, some night school classes or whatever, but 4 years, the gravy train's over. You better get a degree and get something that can help employ you, or go to a trade school or something like that that would get him some higher level potential possibilities. I mean, without a college education doesn't mean you can't make money. There's tons of people with no college educations that out-earn me, and I make a good living. So I have a college education, but I don't attribute my college education at all to what I make in this business. It's just hard work. It's just focusing. It's just learning products and strategies, and repetitive in the business for 30 or 40 years, you kind of learn stuff. So if he doesn't get something that he can grow and develop and make better, if he's just going to work as a paycheck employee and do what most teenagers and people going to college do, he's going to stay in that rut. And if you're paying all the rest of his bills, he has no incentive to do so. So I'm not a family counselor or anything like that, but I would imagine that's probably the tone that they would take just in seeing it. And by the way, I mean, I'm not saying this to belittle you or anything. We all love our kids. We want to help them. We hate to see them suffer. And I'm the same way. Honestly, I have a really hard time drawing the line between how much I help my kids and how much I want them to suffer like I did in those beginning years, so they can enjoy and not take for granted the blessings that they end up with in their later years of life. So I think in reality, you've got to kind of balance I don't want my kid to have to suffer and have it hard like I did. I want to make it easy for him. But then again, you're taking away the lessons and the experience and those things that make life worth living and make enjoying life in the later years when you have done it on your own and not just mooched off parents and then took an inheritance, or like a trust kid. I see trust kids all the time, and they're not very happy. They have everything they need, but they're just never happy enough. Nobody can ever do enough for them because they've just been kind of in that entitlement mentality for so long. So I appreciate where you're coming from. You're not the only one in that bucket, but I have all too often seen that situation run too long and cause my clients hardship in the future because they don't have the ability to say no. It's maybe considered a little bit more tough love, but it's love. I know we love our kids. We want to make it easy, but we also need to love our kids to make it, to let them learn and let them fly and maybe force them. Eventually a mother bird kicks their birds out of the nest. They don't let them stay forever. That's just nature. So if we want to go against nature, you might run out of money trying to raise your kid, and then there'll be nothing for inheritance for him or the others. So consider that. I know that's maybe a harsh answer. It's my best answer. It's all I hope that people want from me is honesty and transparency. And I try to do that, try to be as tactful as I can about it. But it's kind of a hard question, but I'm glad you asked it, because there's a lot of people in that boat, and it's not an easy decision to make, but the hardest decision for you to make might be the best decision you make for your child.
And Jeff, I don't often give my opinion on things, but I want people to think about this. We spend a lot of time thinking about how to raise our kids to be great kids, when we should really be thinking about training our kids to be good adults. And you mentioned tough love. I don't think it's tough love. It's just love. And I think I would tell John that you sit down with a kid and you say, look, Mom and I are draining our savings to support you. We love you very much, but I'm going to give you 120 days here, and it's going to end. Here's what I want you to do. In these 120 days, I want you to find a job, a better job, or if you want to go to school, we'll support you. We will pay for that for you. And we will love you, but you're going to have to support yourself in 120 days. We will be your biggest cheerleaders, but you've got to leave the nest. So anyway, John, we really appreciate you listening to us in Catalina Foothills. All the best to you, and we appreciate everybody sending these questions in. Listening to Premier Retirement with Jeff Hogan, I'm Jeff Shade. Glad you could join us again this holiday weekend. We hope you're having a great 4th of July weekend. We want you to have a safe one as well, too. 520-780-9059 is our number. If you would like to have your Premier Retirement consultation with Jeff at no cost and no obligation to maybe declare your financial independence, again, 520-780-9059. You can make the call right now. No questions off limits. Again, it's just a casual conversation. Call and leave your name and telephone number. Shelley will call you back next week and set up that appointment for you. Once again, it's 520-780-9059. Well, this weekend, Jeff, America celebrates its 250th birthday and the signing of the Declaration of Independence, and it reminds us that freedom is something worth protecting. Jeff, when people hear the term financial independence, they often think it's all about having a lot of money. Is that really what it means?
I think the biggest thing is independence, or I guess freedom from stress, freedom from wondering how your bills are going to get paid, freedom from wondering if you have to go to a nursing home someday, you'll be taken care of, freedom to know that your heirs have an outline of how things are supposed to go so they don't fight and hate each other after you're gone. It's basically where your financial decisions are driven by your goals, and you get that peace of mind knowing that things can happen the way you want to. I think that becomes financial independence, is where you're not dependent on a job for income. You're not dependent on Social Security being there forever and having cost of living adjustments, Medicare always paying your bills. I mean, the financial freedom or independence would be knowing that there's enough buffer in your plan to cover those things if they don't play out as hoped, because there's not a whole lot of things that are certain. So the more certainty you can build into a plan, the more freedom you get. Yeah, you've had 40 or 50 years of working and earning and saving and basically preparing for this thing called retirement. Now you're in the waters of retirement. You're sailing on the boat now, and you can't go back to shore. You know, what you brought is what you brought. You got to make it work. So the retirement funds have to work. You can't squander them or risk them in bad stock market decisions or make an investment you're not really sure about that sounds good but might not be. I think financial independence, again, isn't about becoming rich. It's about gaining the freedom not to worry about how tomorrow's bills are going to get paid, or not worry about if you can still finance your life just in case you live past age 90. It was an interesting meme on Facebook or something I was seeing the other day. It said, I just did my financial plan. It says I can retire when I'm 90 and I probably can live for 11 months. It's like some people, work really hard forever to get there. We want you to be able to retire whatever age you are and say, I can live for 40 years because my money is working for me, because I have fixed programs that are guaranteed to generate the income I need. I have no bills. My kids are independent and they're okay and not requiring me to pay their rent or their medical bills. They're doing good on their own. Hopefully that's the case. And if they're not, then maybe we have to include that in the plan, but not like the failure to launch question we had. We always want to be there, be able to help in a financial crisis, those people that we love. And we need to build that kind of a thing into a plan. So financial independence just means getting to that place where you finally have peace of mind or confidence that no matter what happens, whether it be government situations, political issues, new laws or regulations, that you're in a position and flexible enough to move and bob with those changes and live your retirement on your terms. That's financial independence. Not very many people hit true financial independence, but with a plan, you can get dang close. And with a good enough plan, and if you've saved enough, and if you've done a lot of the right things, and not everybody has, sometimes we have to wing it, get as close as we can. But again, financial independence is just relieving yourself of that worry and those unknowns.
Jeff, people often use $1 million as the magic retirement number. Is reaching that milestone enough to create financial independence?
Well, it depends. If you've got a big pension, you could probably do it on zero savings. If you were self-employed and you have $1 million and you've decided to file as an S Corp and not paying the Social Security like so many people do, and then they find out, I don't have that Social Security paycheck coming, and Maybe if your wife was a stay-at-home mom or didn't work that much, doesn't have a big Social Security check, they don't even get half of your big one if you would have paid in. So Social Security turns out in many cases to be a decent retirement plan if you paid into it. But if you didn't pay into it, I hope you saved more than $1 million, because that $1 million is only going to generate probably $50,000 a year for you and a spouse till you die. If you don't have any bills, maybe you can eke that out on that much money. But I think if you got $1 million, that's good. If you've got some pension and Social Security, maybe you've got $50,000 a year coming between you and a spouse on Social Security, and that $1 million is going to generate another 50 or 60. That's a little over 100, and you have no bills. I mean, it should be okay. Again, it depends. Some people need $2 or $3 million. Some people have a pension and don't need a whole lot. Some people have huge lifestyles. I've got a plan. Actually, I'm going to talk with a guy on Zoom. He says, I've got $10 million and I need to live on at least $50,000 a month. Well, okay, he's got some pretty heavy lifting to do here with $10 million. That might be a little bit of a push. Not really. He's got some other assets and things in real estate that could possibly be used, but some people have high expectations. I think what you have to do, depending on what you have, is $500,000 enough? Yeah, sure it is. If you can live on a responsible amount of withdrawal from those, and it might mean you downsize your house or you take less expensive trips and you do a few less things if you haven't saved enough. So again, the more you've saved, the more fun you can have. I'm sure the guy on $50,000 a month can have a little bit more fun than somebody that's taking out $10,000 a month from his retirement plan. Again, what we do is when we build a plan is whether it's $1 million or several million or somewhere in between zero and hundreds of millions, whatever it is, we build a plan that'll save you as much taxes as we can, provide as much income as you need, have enough buffer, build a legacy plan if you want to do that, give to charity if you want to do that, and build a plan that'll say this is a reasonable amount of money to live on. And if you don't have an abundance of extra cash, what's the maximum I can be comfortable living on and still have those emergency funds and those what if dollars and enough wiggle room to bob and weave through the changes that might happen in the future? So again, is $1 million enough? My old answer to every question is it depends.
Jeff, if someone's listening to the program today, they're 5 years away from retirement. Their goal is to declare their independence from a paycheck. Is that enough time to turn things around if they're not on track?
Depends how not on track they are. Here we go. It depends. If I had a guy come in and say, it was funny. My son actually was on the call. He says, the guy calls and says, yeah, well, I have 200 to retire. I want to know how much income I can get. I'm like, well, geez, that's not going to be a whole lot, maybe $1,500 a month or so. And then when he called back and showed him the place, he says, well, I don't have the 200 yet. I only have 80, but I want 200 in the next 5 years so that I can retire on 200. Like, wait a minute. I mean, I'm sorry, 87 is not going to get you. That's not even emergency fund. So, I mean, this guy was so far behind that he hadn't even started yet, and he was already in his 60s. So there are some people that basically never really got up the mountain, let alone come down off the mountain of retirement. They might have a little bit longer to work. This person happens to be single, but they got to marry a rich girl or somebody that can at least supplement with another Social Security paycheck or something. But some people have unrealistic expectations as to what that extra 5 years could generate. I've talked to many people in the very recent past that we find out that you don't really have to work anymore. You're okay if you structure your assets into income producing accounts that are guaranteed forever. And if you still have enough money to play with and invest, you're going to be okay. And sometimes they're like, I had one lady came and she just started crying. She says, I didn't think I could retire till I was 70. I didn't realize I was so close. And it's a moving experience to know that you're giving the people that kind of confidence that they like, oh my gosh, I was trapped in this belief that I would never be able to retire. And yet, if you structure my money in something other than stocks and bonds, we can actually do it. Well, it's a nice answer to be able to give, and we can more often than not. But unfortunately, you have to have realistic expectations when you come in for a plan. And if you don't have realistic expectations, we can help you adjust your lifestyle based on what you have. And this particular gentleman I told you about that called in and asked for a little bit of help really wasn't in a position where we could help him much. But yeah, we'll let you know if that's the case or not. And you might find out that we can help you a lot more than you thought.
Jeff, once again, this has been a great conversation. Really appreciate your time in this holiday weekend. I want to talk to our listeners here for just a moment. As America celebrates 250 years of freedom this 4th of July weekend, it's the perfect time to ask yourself an important question. Have you created your own financial independence? Well, if you're within 5 years of retirement or already retired, right now is an excellent time to make sure that your plan is built for the future. Call us here at Premier Retirement today at 520-780-9059 and request your Premier Retirement Roadmap, a roadmap that could possibly lead to financial freedom. That's 520-780-9059. This Independence Day, celebrate more than America's freedom. Take that next step towards achieving your own financial independence and retire with confidence. Well, Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, as always, I want to thank our great listeners here in the Tucson area for joining us, and we wish you a happy 4th of July weekend. Have a safe and a great one. Be sure to join us again next week right here with another edition of Premier Retirement on 790 KNST. We are Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.